Welcome everybody. Welcome to an event sponsored by the SFA ACM chapter. Tonight's talk is how Silicon Valley Bank crashed, and our special guest host is Benjamin Solomon. So welcome.
Hi.
If you're not familiar, an introduction about our chapter of the ACM. We are a professional organization founded quite a while ago in 1957. And our purpose for being is to serve the computer science professional sector. And we do things like meet here on a cadence of about twice a month, serving topics of general computing and also data science. We invite you to join as an annual member. It's only $20 a year. And so if you're interested, please see me anytime you're in the meeting. Always are looking for volunteers. So if you are interested in serving in various capacities, such as finance or helping us promote our events, again, please let one of us in the room know as well. I would like to take this time to acknowledge our sponsors. One is Front Egg. They are a startup and they are they're in the area of identity management. Next slide. And another. RXM. This is a professional association that helps promote and develop DevOps and platforms for various technologies. Next slide. And an upcoming event that we want to make you aware of is one that's put on. It's called AI Days SF. It'll be in San Francisco. Let's see. It is on February 6th, 2025, from like 9 a.m. to 9 p.m. So if you're interested, please, check out more about this. It is also a fundraiser that helps. We're a co-sponsor of the ACM, and it helps us in putting on programs. So now I'd like to, kick off the meeting and welcome our guest speaker, Benjamin Solomon. And then if you could just introduce yourself, and I'll hand you over the mic.
Hi, I'm Ben. I spent at least 10 years in credit risk for an investment. I spent 10 years in credit risk looking at commercial property loans and how they fail. I also looked at FICO scores and how they work, and also a few other things. Okay, so let me just start with this, and then we will, as your questions come up, we can ask. Okay, so there are three things that you have to be always reminded of, which is, one is awareness. Do you see what you see? Do you see what you know, or do you know what you see? And sometimes there's a big difference between the two of this, and sometimes you don't even see what you know. For example, in this photo, you see, what do you see? Do you know which country it was taken from? Yes?
Sicily.
Could be. You can see from the lights that it is drive on the right-hand side. So it is, what? It could be anywhere in Americas, North or South America. It could be Europe, or it could be other countries where they drive on the right-hand side. But the one thing you cannot tell is which country it is.
But it's not British Commonwealth or Japan.
No. Because they drive on the other side.
Right. It's not those two.
Yeah. Okay. The second item is what the late Professor Morris Klein said in his book, Mathematics, the Loss of Certainty. Okay. If I stand up, probably speak louder. So what Professor Morris Klein wrote in his book, Mathematics, The Loss of Certainty, is that mathematics has become so sophisticated that it can be used to prove anything. Okay, so my advice is mathematics is extremely important, but don't fall in love with it. We'll see later that a lot of the failures, some of the failures in modeling risk is because the experts fell in love with their models. And the third thing is that randomness and probabilities are two different things. So you have a substrate of electron shells or a group of people. Most of them are not ready to buy your products. Some of them are, but you use marketing to introduce your product, bring awareness, but you use sales to get the commitment from that reduced set of prospects, because you don't want to deal with everybody. You waste your time and energy trying to reach out to everybody when they're not going to buy. So you use a sales funnel to reduce the number of people you actually talk to. So one of the most important question, what happened? Okay. The surprising thing when I did this many years ago, one of the surprising things I realized is that physicists spend millions of man hours figuring out the probability distributions and how those distributions affect materials, but they do not ask one question: how does nature implement? And I propose that probabilities are actually functions are actually a form of it. When you throw a die, when you throw a dice, you impart kinetic energy, and then when it comes to a stop, it's lost that kinetic energy, and you know what the value is. But when it's rolling around, has that energy, uh, it, anything can happen. Any number can surface. Okay, so types of credit risk. In this presentation, we only talk about 2.5. Consumer credit, residential or commercial credit, and company credit risk is a very big topic. I use SVB, Silicon Valley Bank, to explain how credit risk went wrong. Okay, let's start with consumer credit. Okay, so John has a FICO score of 850 and Phil has a FICO score of 530. Who do you think is most likely to default in the next 3 years?
Bill,
That's what I used to think. I really believe that FICO scores were great predictors of defaults. It's not right.
unless Phil wants to improve himself and it's driven that way, and John doesn't care.
It doesn't work that way. It takes too long. Okay. So, in 2007, I received a set of tapes of residential mortgages that were originated in 2004. Okay. The tapes is the old terminology. They're actually Excel spreadsheets. Okay. Now, what I did was I plotted a distribution of FICO scores, and it came out to be a normal, very nice normal distribution. And I was thinking, like you do, like you all did, that if a default happens, you expect the lower scores to have higher default rates than the high scores, right? But no. The tapes contain information about the borrower, the amount of loan, the amount of the loans that they have taken, and also their monthly payments, and also whether they have defaulted. So I took out all the defaulted loans and looked back at what their probability distributions of their scores at origination were. It was this. It was identical to the original population sample. So FICO scores cannot tell the difference whether a person will default or not 3 years out. If you look at lending, it's if let's say a dealer pulls your credit and then you don't buy the car, but you come back 2-3 weeks later, they will require you to pull your credit again if it's more than 2 weeks. And so you need to know what risk you're modeling and also the horizon. FICO scores are probably valid for about 30 days to 90 days. This was a shock to me, finding out that FICO scores are not good predictors of defaults. Okay. The reason why is because consumer credit scoring, FICO is the most popular, is a lagging indicator. What happens is consumers make their transactions, and then the bank sees those transactions, reports the loan repayments transactions, and then it sends to the rating agencies, and the rating agencies then evaluate what your credit rating is, and then the consumer knows what their credit score is. It's a lagging indicator. It's in the past. It does not explain, does not attempt to forecast the likelihood of default. And we saw that in the previous slide, there's no ability to forecast previous default. And it's not easy to switch a lagging indicator to a leading indicator because there are a lot of pieces that are missing. Okay. The other thing about statistical tools is hypothesis testing. Where you have now hypothesis which you believe that the obligor will pay in full, and you have the alternate hypothesis that he will default at some point. Okay, and type 1 is here, type 1 error. So if you look at this piece here, the null hypothesis is the person is a good borrower, but if the credit scoring comes back and says 800, okay, great, they both agree. But if the credit scoring says no, it's 520, and so the bank will not lend, and that's revenue loss for the bank because it is the person has a high credit score. Okay, and an example of that would be when I was in LA, I had a customer who believed he had 750 credit score, and he applied for a loan. And when we pulled, he had great income. He had made all his payments as far as he knew. And then when we pulled his credit report, it came out at 520. Why? Because he disputed a medical bill of $1,000. His income was at least 70 times that. So yeah, so we knew he had the ability to pay. We knew he didn't have that much debt. It was very small amount, but his credit score was quite good. So that in that case, you have the type 1 error. You're not lending, the bank is not lending, and so it's losing revenue. The type 2 error is when the poor borrower does not have the ability to repay loans. Okay. But the credit scoring says very good credit. And that happens when a person is, for example, fresh out of college, he's opened a credit card, doesn't have anything else. So this person might have an 850 credit score. Another person who has had several mortgages and car loans will also have a 850 credit score. The banks will look at the credit history. It's not enough to look at the score. The banks will look at the credit history and determine what you're eligible for in terms of your interest rates. So the 850 with solid credit history, it's called depth of history, will get a much lower rate than somebody who, let's say, has only bought pizza with his credit card. That paid it off. That's not enough history to show how good that person is. So he's not considered a good borrower. Okay.
But the question is, someone with an 850 score and with only one transaction should not have a score of 850.
No, you do see it.
Oh, really?
Yeah.
I thought the history also is a factor into your score.
Yes, but we still do see it. In
So it's like a freshly starting school student starts with A average until second and goes to B.
No, it goes from the auto industry calls that these people ghost. They have no credit history. Let's say if you completed your mortgage, you completed your loan, your car loan, and you don't have any other loans. If you do not have credit, loan or something in over a 7 years period, you're considered ghost because there's no credit history. Because all that after 7 years falls off. Okay. And people who have just like we have seen a lot of students have just arrived. They come in by one case was this guy from China. He had a PhD. He had come in to do a PhD, and which is beside the topic, but I'll explain. He came in 3 days after he landed with this social security card, and he said, "I want to buy that car." So we did. We negotiated everything, and then we pulled his credit. Technically, he had only his social security number for 3 days. But his credit history went back 25 years. We couldn't give him the loan because somebody else had. It was basically identity theft. Okay, so there are those sort of things going on. Okay, now this is a little bit busy. The loan age covered call default model is something I developed a few years back. It's based on this default behavior. So the default behavior peaks in year 4. Let me break this up into 2 simpler slides. So here you have the loan, the borrower's default function. This is how they usually behave. For residential and commercial mortgages, it peaks at 4 years, sometimes 3 years. This side is considered seasoning. That's to get rid of, that's the time when most of the weak borrowers default. On this side, it's called lifetime defaults. And what this graph is, okay, so this population up here are regular mortgage borrowers. And in that population, you also have previous subpopulation, which means that they are financially savvy, they're always looking out for a better deal. They are different from the regular borrowers. Okay, so they are prepayers, so when they find a better deal, they get the other bank to pay off and then start a new loan. Okay. In this area are the defaulters, default subpopulation. And this is these people in this population are not so financially savvy. Maybe they lost a job. Most people can handle maybe 3 months of mortgage payments before they give up. So they have lost their job, they have defaulted, and the bank repossesses. So there is the hazard model. If I recall, the name is a hazard model, which basically combines the pre-peer population with the defaulter subpopulation, which, in my opinion, is the wrong thing to do because these two populations are completely different.
Yeah. Together, ARMs and fixed rate mortgages as well.
This is just fixed rate.
Just
It's similar behavior with ARMs. Most of the work has been done only on fixed rate. ARMs can tend to get a little bit more complicated.
okay.
Okay. And anyway, it should follow the same pattern because defaults are almost always due to a loss of income. Okay. Let me go to the next one. Okay. So we have the borrowers, the sustainable cash flow line, which basically says people below this line is how good is your cash flow, your income and your expenses. Okay. And so it's basically your credit. And this one here, this is your borrower's default function, which is how borrowers in portfolios default. So what the point is that at this region, your default function and your credit risk function are the same. Here they part. You can see about 3% of the population of borrowers that are approved have some problems with their cash flow, but they still get approved. So that is your part of your type 2 response origins. So at this height here is private information. And from this default and down is public information. Because let's say borrower had some cash flow problems, he knows he needs to make his payment by such a date every month. So he borrows from family and friends and makes up the payments. But when that runs out, or he does not have access to those external funds, he defaults, and the bank forecloses on that default. And when the bank forecloses, that is public information. So when you say credit risk, there's a lot of private information there. You cannot actually measure it. You have to be able to model it. And one of the early papers suggested that you can use default risk for your credit risk. That's true in the latter part of the age of the loan, but it's not true up here. And the reason why that's a problem with Dodd-Frank, because Dodd-Frank has a section called risk retention, which investment bankers who issue bonds based on mortgages, they have to cover the first 5% of the credit risk.
Excuse me, Ben.
Yeah.
Yeah, question from remote viewers. Is this assuming a 30-year mortgage term, or is it averaging outcomes across 10-year, 15-year, 30-year, 40-year, so on?
Most of the mortgages are done on 30 years. But most of the mortgages are done on 30 years. Most of the
So the
analysis
data
done.
for this graph is from 30-year mortgages?
I believe so.
Okay.
It's
thank you.
been quite a while since
Ah,
so I believe it's 30-year mortgages. Most people do 30-year mortgages.
yeah.
Okay.
Okay, thank you.
And where was I? Okay, so the law does not have a clear definition of credit risk. It's not implementable. Okay, so that is one of the weaknesses with Dodd-Frank. Oh, let me explain this. This is the lender's default function, which is what is the probability that the lender will foreclose on your mortgage because you have defaulted. So, and it's a line like this. It's 100% after the mode, but it rises from 0 to 100% before the mode. So when you multiply this lender's default function with the credit risk, the sustainable cash flow line, you get this curve, which is the borrower's default function. So a lot of the times you can use that straight line to estimate what your default function is going to look like. It's a shortcut, but okay. So portfolio loss given default. Here I will combine a portfolio loss with SVB. SVB is a good example. Okay, so this is the portfolio stress testing. Those days in the early 2000s, that name didn't exist. It's since Obama and the Great Recession that they gave it an official name. It's called stress testing. But this type of work was going on easily 10 years before. So this is the probability of losses for a portfolio of mortgages, and it has a long tail to the left. And when I started working on this graph took about 10 years to put together. When I started working on this, the methodology that the bank used was mean times 1, mean times 2, mean times 3. And I asked, why are you doing this? Why are you doing this? Doesn't make sense. Nobody had an answer because people come and go, and then at some point they forget why they did that. It's because first the assumption was losses were normally distributed. Then when I started looking at the portfolio means and standard deviations, I found that the mean and the standard deviations were very close. If the mean was 1.05, the standard deviation would be 1.2 on that sort of scale. So the times 1 and times 2 and times 3 was using the means as an estimate for the standard deviation. Yeah. Because the standard deviation, the mean was very small. Okay, so that explains why the industry originally used times 1, times 2, times 3. So the industry eventually shifted to value at risk bar, which is the 98th percentile. Almost always it's the 98th percentile, once in 50 years. Major break in the catastrophic loss. Okay, and this is not a coherent measure of risk. What I did was, since I found out about conditional value of risk, that SIBA, Asner, and 3 other guys wrote up a paper in 94 or 97. Okay, and this has SIBA has more stable properties than VAR. So what you get is SIBA is basically considered the weighted average expected value in this region. So the bar tends to be between 5 and 7 times the mean. C-bar tends to be 3 to 7 times bar, or 15 to 35 times the mean. So the tails are quite long. Okay, and the loss, the why this and this, and for a while this was a very hot topic of research, because these two metrics are in dollar values. So you can say I have a 22 million portfolio, and my worst case loss at par would be $1 million. So they know you set aside $1 million just to handle that loss. What I found out was black swans are between 30 to 70. So these are good estimates of what if you know what your mean is, you know what your worst case losses are going to be, or your tail loss is going to be. So that I'm using the terminology very loosely, because different papers will have different definitions of tail loss, extreme loss. But this, you know what this is going to be, and you know what the bar is going to be. Black swans, be careful. Not everything can become a black swan. They have to have specific distribution types before they can become black swan. For example, a GDP, you can have a massive contraction in GDP, but it's not a black swan. Okay, so the term has been used very loosely. It's not applied correctly.
And why massive contraction in GDP is not a black swan even?
Because it's basically a normal distribution, or close to normal distribution. And so the tail of the normal distribution is very large, but it's not a black swan. Black swans tend to be a version of a uniform distribution. And the most important factor for black swan to occur is power law distribution, or a constrained power law distribution. That means you say the lower bound is one value and the upper bound is another value. That constrained power law distribution, I call it Levi distribution, because Levi was one of the people who did random walks, studied random walks. But the statistics behind a constrained power law distribution, and an unconstrained one are completely different. It behaves like a completely new type of distribution. Yeah.
You said it's not a normal curve. Is it a log normal?
Oh, yeah. Let me talk about, I forgot. Fat tails. A lot of the papers talked about fat tails. Fat tails are an artifact of the technique you're using in the scales regression. So what happens is that you have maybe 3 or 4 points in your tail, and you have maybe 100 points in your main body of the distribution. When you apply regression, any form of regression, it's the regression's trying to fit the most number of points, so it focuses on this, and it raises the tail, so it looks like a fat tail. It's an artifact of the technique. So you have to be careful when you use statistical techniques. You have to be careful that the technique does not break down. A lot of people use regression without checking the errors. The errors must be normally distributed. If it's not normally distributed, regression theory is no longer valid. And the worst use of regression is when you do log transformation. Yeah.
Another question. remotely. Why does portfolio stress testing abstract away key variables like Fed base rate, inflation, unemployment rate, US GDP growth, contraction? What values for those does this assume?
Can you repeat that question?
Sure. Why does portfolio stress testing abstract away key variables like the Fed base rate, inflation?
Oh, yeah, it's stress testing in terms of defaults. It's not stress testing in terms of whether you are trying to maximize your profits or that's all. It's a specific portfolio losses. The probability distribution of portfolio mortgage losses is a skewed distribution with a long tail to the right.
Okay, thank you.
Where was I? Oh yeah, technique failure. So you have to be. About 20 years ago, I was doing regression and I got an app ratio. I like app ratios. I don't like the p-values so much, even though they mean the same thing. Usually app ratios are about 100, few hundred to a few thousand. I got an app ratio of 164,000. I was so elated. But at that time, I had not realized that techniques break down. So you have to be careful. When you see such a high number, you have to double check and see what's going on. Okay, now coming to Silicon Valley Bank. A lot of my focus right now is on startups and how startups fail. So Silicon Valley Bank is a 47-year-old startup. That's one way of looking at it. So when you have a startup, you have to identify who is responsible for what, the CFO, the CEO, the COO, because in the early stages of startups, everybody is doing practically everything that's going on. And then they start building, they grow, and the size of the stuff doubles, triples, and people start specializing. But at some point, need to be able to identify who is responsible for what line item on your financial statement. Okay? Like the CFO is responsible for equity. Okay. And why do I point out equity, not everything else? There are different ways of viewing financial statements. The Japanese have a slightly different way of viewing financial statements than Americans. Why is this important? Any suggestions? In a capitalist society, why is equity important to look at?
Because this is what the shareholders have put money in the company.
Yes. In capitalism is about capital formation. If you are successful, this will steadily grow.
But I've always been trained that you look at the equity over time and changes to it.
Yeah.
The absolute values are a little less meaningful than a change in it.
Yes.
But that's not quite what your statement.
No, all I'm saying is look at this number.
Okay.
I'm not talking about how it must grow steadily for capitalism to be successful.
Got it.
The question is, as individuals, how do you participate in capitalism?
Shares something.
Is a pretty right.
Hmm?
My question here is how come debt is not the responsibility of the CFO?
Yeah,
You don't have debt.
it could be.
There's no debt here, so that's interesting.
No, no, there are net loans here. And the banking balance sheet is reversed. So when you lend out loans, that's called assets. When you take in deposits, that's called liabilities.
You take deposit liabilities, but in terms of the corporate functioning, you may be taking debt from the market. So you're issuing bank one is
Yes.
that kind of debt.
Yeah.
This is different.
Picked out, this is not a complete list. I just picked out the key features. And what I wanted to highlight is the equity portion. As individuals, how do you participate in capitalism? We know companies are about capitalism, but as individuals. Stock market is, yes, one way. When you put your money into a bank and they pay you interest, in the next period, that interest is considered capital and you get more interest. That's how most people participate in capitalism. And they don't know that's what they're doing. That's a very basic form of capitalism. Okay, and then you can say that American capitalism is individual based. In the Soviet Union, they did practice capitalism, but only the state was allowed to do capital formation. So that's the key difference. Okay, the next two slides is about SVB, 16th largest bank, but the largest bank failure in history. Okay, some key points. In 2021, they had 189 billion in new deposits. They bought 100 billion in bonds. 22, they lost 30 billion in new deposits, and their book value of the 100 billion bonds lost 17 billion. And in 23, 42 billion deposits were withdrawn. That's a very massive scale.
So if
Okay.
there was no bank run, would it have paid?
What?
If there was bank run, like they lost so many depositors.
Yeah.
If there was no bank run,
Yeah.
those 36 hours, would it have paid?
No, it would
That's
have.
the key, because
Is-
what happened is because
Yes.
once the interest rates went
Yes.
up and
You have to have a trigger before a bank run happen and the bank fails. Okay, so you can see here, this is the last 3 quarters of 2022. They lost deposits of about 24 billion. So they knew that something was not quite working right. Okay, on March 9th, they lost 42 billion. Because this is Silicon Valley. Within seconds, your friends know there's something wrong. Before you know it, everybody knows by email, by text messages. It was not like 40 years ago, 50 years ago, that bank run would be very slow. It will be 3 or 4 days, maybe a week before the full.
right, 20 billion in 3 quarters, those 3 quarters.
I didn't look into that. I'm looking at the numbers and inferring what happened. So this suggests, and I'll talk about it a little later, that the CRO did not have the authority she needed, and it shows up in the financial statements. Okay. So here I did a quick and dirty reconstruction of the bank as of March when the Fed seized the bank. You see that the cash position here is about 14 billion. And by March, I set it at 500 million, assuming that the executive team would set aside funds to pay salaries and wages. Okay, if they had not, that number would be zero. And then here you had 120 billion in investments, and you can calculate the numbers, make some assumptions. It's about 92, 95. So I used held to maturity at 91 billion as what they could not sell off in time.
So if Silicon Valley Bank did not buy all those bonds, they would have been okay. So they made the investment, it was a bad investment, means they should have kept some reserves. That they bought all those bonds and, Fed raised those interest rates rapidly, bond prices fell, so they had less on the.
Agree. There are other issues in there, but I'll talk about something. So when we dropped the deposits from 173 billion to 131 because of the 42 billion withdrawals, and you set equity to zero because when the Feds take over the bank, it's worth nothing. There's a hole of 16.2 billion. The balance sheet cannot balance because of this hole of 16.2.
But they held those treasury bonds, right?
That's on this side. On the asset side, the balance sheet, the liability side of the balance sheet, you had a hole of 16 billion, which is very close to what to the discount that the Feds gave for Silicon Valley Bank to First Citizens to buy over the bank. It was 16.5, which is basically this, which is essentially when it's quick and dirty, it's essentially that number. That was the size of the hole. You couldn't balance the balance sheet because of the stunning loss of that amount. Okay. Now, one important thing is that this bank was top heavy. Look at the non-current assets, the long-term assets, only 4 billion compared to 200 billion in terms of current assets. So practically everything was at the top, not in the long term. This is a very dangerous way to operate. I have only one company I've seen that operates like this. It's a Japanese electronics manufacturer out in Malaysia, and they are completely, almost, there's practically nothing at the long-term structure. But it worked for that because their vendors was a sister subsidiary and their buyers was sister subsidiary. So it was guaranteed. Their material inputs that they were getting was guaranteed, and the who they were selling to was also guaranteed. So it's what I call a captive company. It works, this sort of balance sheet structure works for a captive company, but because they didn't want to maintain the wealth in the company, they want to transfer it out to sister companies. It's a conduit. Yeah.
So another question remotely. Do you think this part of the cause was that they did not do their quarterly stress tests because there was a relaxation of existing regulations for banks below 250 billion?
Good question. I'll answer it in probably the next slide or so.
Thank you.
Okay. So Dodd-Frank works down here in the long-term assets. It doesn't work up here. Okay. So Dodd-Frank was irrelevant for SVB. Trump relaxed the rules for smaller banks. And when SVB, in his first term, when SVB crashed, this is not a political statement. It's about understanding the issues. When SVB crashed, Obama said, that's the reason, because Trump relaxed the Dodd-Frank rules. No. Dodd-Frank works down here. It doesn't work up here. The problem with SVB was that everything was at the top. It was a top-heavy bank. This does not work in real life. It didn't even reach 98th percentile. Because it was 47 years old when SVB crashed, so it's 1 in 47. When you're looking at extreme loss, you're looking at least 98%. So it didn't even reach that. And there's a little bit more issues. We have had 11 recessions since the 1940s and several crashes, usually after a recession. So that tells you that every legal structure that has been put into place since a recession has not worked. Because when the next recession comes and you have another set of legal requirements, that's because most of these regulations, in my opinion, are not market savvy. They are written by attorneys for attorneys. That's why you have things like there's no definition for credit risk, even though banks are supposed to set aside 5%. Okay.
Does that come down to the person that defines it when it's in trouble?
What is that?
Well, if you don't define what you're using to make your decisions, then you can't get in trouble.
Yeah, you said if you cannot define.
So if we don't tell regulators how we're making decisions, we can't get in trouble if we violate it.
We don't tell regulators.
In other words, if you're not following any rule, then you don't have to worry. You can ask for forgiveness.
That's what's happening right now. The question was, if you don't have any rules.
I'll ask it as a question. Isn't it convenient not to have a rule? Because then you can't be wrong and get in trouble for not being correct.
Okay, the question was, isn't it convenient not to have any rules? Then you cannot get into trouble. You cannot be blamed for it. You cannot be accountable.
Yes.
Okay.
This.
Yes, but market forces are there independently of whether Congress lays out legislature or not. So the market forces are probably the best ruler. Okay, sometimes it takes too long. People get fed up. Hey, the banks are being nasty, or the oil companies are being nasty, or some of the landlords are being nasty. But eventually it'll right itself. It's just that we are not appreciating the time it takes to right itself. Okay, if you have real free markets. If you are coming out of a third world country where politicians have deep control over the state, then free markets don't exist.
Okay, now there's two sides to this.
Yeah.
Free market is good, mostly, but it also means that those participating in it need to be informed and intelligent. If I look at this, I'd say, yeah, that's probably that makes sense, what you
Right.
said there.
Yeah.
But why did that happen? It's because corporations, individuals, whatever, made a decision to have massively huge accounts being held at Silicon Valley Bank, multiples above what the Federal Deposit Insurance Corporation would guarantee in the event of a failure. So a prudent person would say, oh my God, the bank's gonna fail. I better pull that out of there because I was not protected. If I had split the assets up with all the different medium, high, and whatever banks all over, I say, nothing to worry about. Everything's protected. I'm not
Yes.
gonna withdraw anything.
Yeah, but if you're
Yeah.
depositing, say, $50 million, how many banks are you going to split?
That's, yes,
It's a
and
scaling issue.
it's work. It's work to manage it. It's work to do all that.
I agree.
It
My
wasn't the bank's
my
fault.
recommendation is don't put all your money into one bank.
Right.
Split it around 5 or 6. I think I remember reading a rule that 250,000 applies to all your accounts, not just one account. So what the Feds have done since they've insured working codes, they've come back and said, yeah, we will cover everything, especially in Silicon Valley's banks crash. They said they will cover everything. So that insurance, the Fed is behaving more like a bank of last resort rather than an insurance entity. So the behavior has changed.
Yeah, probably they applied it only to Silicon Valley Bank. If it was some other bank,
So there are 2 other banks that
the
failed.
First Republic. That's it.
First Republic and there is another one. But I didn't look at their financial statements, so I will not comment on those 2.
Why was Silicon Valley Bank top heavy? The reason is because
Because they had 173 billion in deposits, which are short term. You can take it out tomorrow or today.
Too much
because,
cash.
startups are, it's more like a checking account, so they have
Yes.
to put it.
Yes. So there needs to be a better way of solving this problem. So there's a thing called duration matching, where you look at the weighted average life of the security. That's not enough. If you have to match, if your deposits, you can lose your deposits, 42 billion in deposits in 24 hours. You need to have investments that you can liquidate in on that scale in that 24-hour period, which they didn't do because Dodd-Frank,
Liquid assets
what
is,
yeah.
is except that those assets became less, they would have faced losses. Because it was all
Yes.
bonds.
Yeah.
The price of the bonds fell,
Yeah,
it's
so-
interest rate.
So you have to mix and match. You need somebody who's really good at looking at short-term
They
assets.
did what I would say good risk management. And
They
they could
did.
have been aware because when the interest rate started going up, it didn't go up from 10 to 5% in one day.
Yes, but they did risk management in what's this? Okay, so let me quote you from the 2022 SEC filings. Interest rate risk is managed by our ALCO, Asset Liability Committee. And the second statement is we utilize a simulation model to perform sensitivity analysis on economic value, equity, and net interest income. Both were inadequate. They had some really great experts who failed the company. And this is not the first time this has happened. When long-term capital management, LTCM, crashed in 1998, they had 2 Nobel laureates on their board. I believe it's Black and Schultz. No. Merton and Schultz. 2 Nobel laureates. So remember earlier I said mathematics and statistics, very important, but don't fall in love with it.
But do you say Silicon Valley Bank here was greedy? They put money in the short-term bonds where they shouldn't have committed all of it?
No, they had to hold it to maturity, which means they
No, because they were trying to They also have to make money, so they were trying to get.
Yeah, they were
maximum
trying to make a profit at any cost.
at any cost. So
Yeah.
I would say that they were greedy. So, and that's where the risk.
No, I'm not going to pass judgment. Where's this? There's a slide I wanted to show you. Here. This is the point I missed on the approximate CxO responsibilities. Look at this. Provisions for credit loss in 2022 was only 420 million. Their total assets was 211 billion. So what sort of say do you think the CRO had? That's why she resigned in March of 2022. She left her position, and the story, I understand the story gets a little bit complicated, but she was no longer CRO by April.
Yeah, but the banks have regulations that they have to have a minimum amount of money for credit loss reserves. So
Risk capital. Risk capital.
Risk capital. So
Yes. No. Where is this? Dodd-Frank requires a risk capital of about, it turns out to be it's around 11% of the banks. So, but Dodd-Frank is operating down here. The problem with SVB was up here. It's not a captive company. It's not a conduit company.
So they did not come under regulations of Dodd-Frank.
Yes.
They took advantage of it.
Yes.
And today, some other bank also can take advantage of that. Right?
Yes. Let me see.
So this was my question.
Yes.
So how many months prior to the official failure did somebody at Silicon Valley Bank know it's going to happen?
If you look at this graph here, the second quarter of 2022, people already knew something was going wrong. Management team did not heed this.
So
Healthy.
I would say it was even before, because if you look at the trend line, it was already decreasing.
Yes, yes, but this should wake up management.
Yeah.
It didn't.
So they had 9 months to do something and nobody did anything to come out in court here.
Yeah. Okay. So why the second lesson? This was the first lesson was the Dodd-Frank stress testing was a utter failure for SVB. The reason why I don't like stress testing, a national stress testing, because from a loss point of view, it makes all the banks look like a single security. What banks need to do is figure out what works for them in terms of stress testing and go with it. Because you do not want a national program to standardize all the banks. Diversification is important. Okay, let's go back to this. Okay. So now we know that Dodd-Frank was irrelevant because it only worked with only 2% of all assets. If you look at a bank run, initially people withdrawing from the banks is always low probability, small amounts. When you have a trigger, it causes the withdrawals to jump, and they are large withdrawals. Okay, this is an estimate of probability distribution of what a bank run with a trigger would look like. The trigger in SVB's case was they filed that they had lost 1.7 billion on the sale of their long-term bonds. That was the trigger that caused the run. If you don't have the trigger, you can probably muddle along for a few more quarters or maybe a few more years before
SVP was not a public company, right?
was a private company.
So why
It was in,
they didn't have
it had shares. It had 15 billion in outstanding shares, and that went to zero in March. So yes, it was a public company.
it was a public.
Public company. Okay. And then if you look at how easy you can liquidate, it's very easy to liquidate small amounts. So it'll be a high probability, and it'll be very difficult to liquidate large amounts. That's why when they try to sell their 100 billion in bonds, they made very large losses, and that triggered the run. So you can see that the probability distribution of the behavior of withdrawals is completely different from the liquidation. There's no way they could have saved the bank, because those two probability distributions are actually working against each other. It could not be saved. Okay. Now, the third lesson. When I was in Malaysia, I was working for a brokerage firm, and every morning I'll walk in to the foyer, take the elevator up to the 40th or 44th floor, one of those floors. And one morning I walked in, and there were about 5 people in the elevator. I got in. The elevator door was about to close. Somebody walked in, and some more people walked in. It got packed, and people started pushing in, and the alarm went off. The elevator was overloaded, and even with the alarm, people kept pushing themselves in. The door wouldn't close because there was always somebody crossing in trying to get into the elevator. Finally, the people outside decided the elevator was too packed. There was no way they were going to get in. The door closed, and the elevator sank. It sank about a foot, a little over a foot. And then 5 minutes went by. I don't know whether anybody had space to press the emergency button, but 5 minutes went by, and then you hear a voice, the security guard saying, "Where's the key? Where's the key?" They didn't know where the key was. And then 10 minutes later, you hear him, he comes back and says, "Where's the key?" So it took about half an hour before they finally found the key and let us out. So that shows you 3 things. What? No, it shows you 3 things. Yes, unprepared is one. But the 2 most important was that even when you know a hazard is going on, you are completely blind to it. Or you are ignoring it. You don't believe, you are in denial that hazard is not happening. That's what happened with SVP. The management team, they let 3/4 of 24 billion being withdrawn from the end in 2022. They were in denial that the bank was having a problem. They let go of their CRO. CRO is a very important person. And they were blindsided. Basically, they lost 42 billion. The Fed took over the bank. So another way of asking the stress testing question is, what is the fire sale value of the bank? Or better one that prompts management to think is, how do you prevent the Fed from seizing your bank? If they had reworded it that way, Dodd-Frank would probably be a lot more effective. Okay. Where's your CRO? Where's your chief risk officer? In SVB Bank's case, with only 400 20 million out of 120 billion, 200 billion was set aside for loan losses. It basically shows that the CRO had no say in the executive team. Okay. A good CRO is an invaluable asset. Why can't a CFO be a CRO? The biggest mistake a bank can make is when the CFO is the CRO. And I've seen it. Why?
Continuity.
What?
No, CFO is responsible for making the bank profitable, which
Yes.
may conflict with
The CROs.
Yeah.
Yeah. You're right also. There's no accountability. Okay. The CFO is responsible for the profitability of the bank and the equity. That's the two most important things. The CRO is responsible to make sure the bottom doesn't fall out. And so there is that conflict. How much money do we make? How much money can we make? Will we still be there tomorrow? In SVB's case, their net income over 2 years was more than 2 billion, but their balance sheet lost 80 billion.
So there's also possible a conflict between short-term and long-term financial growth of the bank. If the CRO were doing the correct thing, they would probably say, we've got to expect the next few quarters are not going to be profitable as the prior quarters if we adjust the portfolio and do that.
Yeah.
But we'll survive.
Your extreme losses is in any period. So until you get new mortgages in and you recalculate it, your VAR is more or less constant. And here, when I was saying this, denial zone, this is where they should have started taking action. If you wait for 98th percentile, you're gone.
Yeah.
Okay, that's what the stress testing does not do. It just says 98th percentile, and you're safe. Yes.
Since they taken during the time, 2022, to avoid the collapse.
Yeah.
They get done back then.
Okay, so they have to make sure that whatever they have in your current assets could be liquidated as quickly as the deposits could have been lost. That's the only thing they could have done. Because Dodd-Frank was irrelevant. And it's minuscule. In SVB's case, it was minuscule. Okay. So that's the end of our discussion. If you have any questions. I'm running a consulting firm. If you have questions, I'll be happy to answer.
Yeah, early in one of your slides, you had the distribution with the defaults versus FICO scores. Does that, how often has that study been made? I'm wondering if it was like
This one.
I think earlier, I think it was maybe the second slide. This one.
Yeah.
Yes, this one.
Yeah.
So how often has this study been performed?
As far as I know, in 2007, I was the only person who did it.
2007. Okay. Okay, so there was
Everybody-
something weird about the economy then.
No, we looked at the economy in 2000. It was good as far as I remember.
2008 was.
Yeah, and that crash was not due to the banks. It was actually that that caused the recession. It was, if you look at the timing, it's a recession that caused the banks to fail. So one of the things I didn't mention is mortgage failures in a recession, and therefore bank failures in a recession, is different from bank failures and mortgage failures in good time. They're two different populations. You cannot add the two. That's why when I was, this, as far as I know, this is the only one that's been done. And I did it because I wanted to find out how good these FICO scores are. And I told my employer they were going to buy $1 billion in mortgages. I told them, don't, because FICO scores are not reliable predictors of default. If they had bought it, they would have lost 300 million.
And kind of related to this, I take it that tranches in mortgage-backed securities take in other variables than just FICO scores.
Yes, loan to value. It's whatever FICO scores for the customer to see how good or bad he is. There was one of my co-workers. This was a few years back here in Sunnyvale. He said he did the car selection, figured out everything, negotiated numbers, and then he asked, "What's your credit score?" And the guy looked at him and said, "I have the best credit score in my family, my entire family. I have the best credit score." So he was really happy. Went to his manager, sales manager, pulled his credit report, came back 499. So yes, when banks give you a loan, they look at things like debt to income ratio. And that can get a little bit complicated because now they have front end debt to income ratio, back end debt to income ratio. Look at how what your income is, and how long you have worked at that your current job. If you work for a big company like Google that sponsors a lot of car sales, you are likely to get a very low rate. But if you work for a nobody company, even the mid-sized small companies are not considered great from a risk point of view. You will get a high rate, maybe 1 or 2% more. But if your credit scores, I've seen banks offer 27% because the credit score was so low. And sometimes people will accept it. Sometimes they'll say, no, we're not going to do the sale. Then the sales manager will hunt around for a lender who will provide a lower rate, maybe 19%. Most people will get about 4 to 7%. And don't be a slave to credit scores, because if your credit score is 800, it's in buckets. So if you go to 850, you might get a tiny reduction. It's not worth it. You want to live your own lives and not be a slave to FICO scores.
Sir, we have a question from John Chambers. Well-known name.
Yeah.
This distribution is conditional on origination, conditional on the bank having actually granted the loan. Do you think the unconditional distribution would look the same? I'm concerned about the potential effect of selection bias here.
No, so is it, can you say that again?
Okay, so this distribution is conditional on origination, conditional on the bank actually granting the loan.
So the distribution is conditional on the bank actually granting the loan. Okay.
And do you think that an unconditional distribution would look the same?
There's no unconditional distribution. For starters, it's illegal to pull somebody's credit score without having a valid reason, like a sale of a car or requirements for mortgage.
Yeah, but you could pull a credit score and not give a loan. I think,
Yes, that does happen, but it's nobody has collected them. Usually when you pull the credit score, the dealers want to sell you the car. They will do everything to get you a loan that you can accept. The reason why the car sales is lost is because the customer will not accept the rate that is offered for his credit risk.
well, I understand, but I think what the question he's asking is, he's saying all of these data here is only from people that did accept, where the loan was made.
Yes. So a simple answer would be the population of defaulters at origination is the same as the population of the borrowers at origination.
Okay.
So the population of those who did not commit to the sale, let's put it that way, is because their scores were too low for them to be able to make the payments at a high interest rate.
Okay.
That's the only way, that's the only thing that's the only way I can
Okay.
figure out how to answer that.
Sorry, so then, okay, this slide is for car loans rather than mortgages.
This is residential mortgages. I was in residential mortgages, commercial property mortgages and residential mortgages. About 10 years, most of it's commercial property.
So then I'm curious, right? Like, you ever, brought these results back to Fair and Isaac or somebody, right? Like, what does the score claim to, predict or correlate with? Like, what does Fair and Isaac actually claim about its score?
So the question is, what does the score claim to me? Okay. You should ask that question to people who develop the scoring models. It's now version 8, and there is a consumer credit score, there's a model, there is a auto loan model, and there's a mortgage model. So there are 3 different models. So right now it's around version 8. They are the people who will be best to be able to answer that question. But my inference is that they believe they can predict future defaults. That's why they do it. And this was a shocker. When I did this, it was a shocker. I basically said it's not able to predict defaults. Any other questions?
What was your sample size for this model when you ran this test?
I think it was about 3,000. Usually I look for a large number.
Yes.
I don't do 100. I don't believe in 125 or 50. Your graph will be very jagged. So I do 100. When I do simulations, it's 100,000 runs minimum.
Okay, well, thank you very much, sir.
Okay, great. I hope you enjoyed the talk.
Clumps of people are so validated.
What? Oh, okay.